Hi, I'm Pattu from freefincal. Today, let's talk about how to choose a multi-asset mutual fund. We shall look at the features of a multi-asset fund by looking at the standard deviation, the maximum drawdown of funds in the category. Now, a multi-asset fund is a new category. It was introduced by SEBI. I think it came into existence only from mid 2018 onwards. There were funds which were having this kind of a feature inbuilt, which for something like Access Triple Advantage Fund, Quantum Multi Asset Funds, or the SL 3-in-1 fund, which later became Navi 3-in-1 fund when they acquired it. So the only requirement that SEBI has of these funds is to hold 10% of equity, 10% of gold, and 10% of bonds at all times. International equity can be there, but it will not be considered as a separate asset class. So you can have funds in this category that are taxed like a debt fund, or the funds that can be taxed like a equity fund. When I say debt fund tax like a debt fund, it means tax like a non-equity fund. That's what I mean. So you can have either. You have to look at the scheme document or the scheme brochure to understand how that works. Since these funds have been around only for the last 3 years or so, we can't look at rolling returns or so. We're not going to do that. But what we will do is to look at the standard deviation and the drawdown. Before we do that, in principle, a multi-asset fund can be used as a one fund portfolio. That is, you can have only just that fund for an entire portfolio, and that will work because there are three asset classes. However, there are quite a big variation in terms of strategy when you consider the funds in this category. So you have to be a little careful with that. So, in principle, that will work for a multi-asset fund, but in practice, it may not be so. And AMC's kind of advertise this fund as asset allocation is important and so on. But that's fine. But the asset allocation of these funds keep fluctuating a lot, so it may not be useful as a one fund portfolio unless you dig deeper, and that's what we're going to do. We are also going to include HDFC Sensex fund as an additional volatility benchmark. New funds in this category exist, like ones from Motilal Oswal, Tata, and Nippon India. I have not considered that. So if you look at the standard deviation over the last 3 years, Quant multi-asset has been the most volatile in the category. It is even more volatile than HDFC Sensex fund. Then you have the funds lower than HDFC Sensex, the Sensex fund. And you can see the least volatile funds are the Quantum multi-asset, which is the fund of fund, SBI multi-asset. These are the least volatile. UTI and Axis have also done reasonably well. The next is we will consider the maximum fall from a peak. Since we are considering the last 3 years, this will include the March 2020 crash, and so this is going to basically represent the fall during the crash. So Nifty fell by 38.3%. Obviously, Sensex also fell by the same amount. Again, Quant multi-asset, it fell almost as much as that. It fell by 32%. Then you have multi-asset, which fell by 31%. Please remember, ICICI multi-asset was earlier known as ICICI Dynamic. I have been investing in this fund since it was a dynamic fund. It was called ICICI Dynamic, excuse me. So it's a equity oriented fund. So in this category, you will find funds which are equity oriented like this. So they take on quite a significant amount of risk. Only funds like Quantum multi-asset, SBI multi-asset, they are maybe UTI multi-asset to some extent. Only they have got a significantly lower drawdown than the Nifty or the Sensex. So they behave like asset allocation funds. They don't behave like equity funds. So in the same category, you have funds which behave like equity funds and which behave like a proper portfolio fund, like an asset allocation fund. So you have to be careful about which you want and which you choose. And you can't do a return comparison with the benchmark because the benchmarks are very weird. They say I'll take 45% of CRISIL 10-year gilt, 40% of Nifty 50, 15% of gold, and all sorts of weird combinations are possible. And UTA does not even mention the percentage of this combination. So it's I don't know how SEBI allows that. Now, if you look at the historical equity allocation, the quant fund is a blue line that fluctuates significantly, and I don't know what they are drinking and to change equity allocation so much month after month. SBI is the orange dots. That's a lot more sedate. And if you look at UTI, it's got a very steady equity allocation. Of course, the equity allocation it's still above 60%, but they've still managed risk very well. So that's a very good thing, because even though it behaves like an equity fund, they have limited the downside significantly for in the UTI multi-asset fund. That's a good thing to see. And also, if you see here, the Axis Triple Advantage, the blue dots, HDFC, the orange dots, and the ICICI fund with the gray dots, they also fluctuate, but not as much. The fluctuation is only from 64% to about 74% equity. So it's about 10% variation. So it's not that much. So again, these funds are equity oriented as such, but but these are slightly more volatile than UTI multi-asset fund. So the SBI and quantum funds are proper asset allocation funds. I think they are the in terms of the low volatility, they behave like a proper in the sense that they are the ones most suitable for your one fund portfolio if you're looking for that. The others are more equity oriented, and they sometimes have low volatility, sometimes have higher volatility, and so on. So my recommendation is, if you are looking for funds in this, you can use a multi-asset fund as a replacement for an aggressive hybrid fund in a long-term portfolio, but those funds should be equity oriented. If you choose something like SBI, then those returns, the volatility will be less, and the long-term returns will also be potentially less. So you have to be careful about how you choose it. Your discerning investor can choose your multi-asset fund as a single fund, as a one fund portfolio for a goal which is like less than 10 years away, 7 to 10 years away, but they still need to be on guard with respect to asset allocation changes in the fund, and they may have to redeem from the fund a couple of years before the goal deadline to ensure to protect from a crash, because when there is a crash, there can be a significant fall in most multi-asset funds. So that's the problem with the category. Although they say it's a category, all of them don't behave the same. There's significant fluctuations. So we have to look at the fund fact sheet, study the history, only then we will be able to decide which to choose and which not to. I mean, for long-term goals, instead of an aggressive hybrid fund, you can consider a multi-asset funds. That's what I'm doing. I'm still invested in ICICI multi-asset. But that's a legacy fund for me. It's not, I mean, I didn't choose it because it became multi-asset. So that's that. You have to do that research and then you can't just pick a fund from this category just by looking at returns and so on. You have to look a little more deeper into the historical equity allocations from the fact sheets.